Ladies and gentlemen, let me start with a question that should stop you in your tracks. What if the price of silver isn't rising by accident, but by permission? What if the very institutions that spent decades suppressing it have quietly stepped aside? Today's title is not just a headline, it's a signal. 100 silver confirmed. Why the banks just stopped fighting the price. And if you listen carefully, this story is not only about metals and markets, it's about power, timing, and preparation. For decades, the silver market has operated under an unusual and highly concentrated structure of control, where a small number of large financial institutions dominated price behavior through extensive short positioning and derivatives exposure. This was not a free market in the purest economic sense. It was a managed environment where price signals were repeatedly distorted. Whenever silver showed momentum driven by genuine demand, it was met with heavy paper selling that overwhelmed natural market forces. This mechanism allowed banks to influence perception, suppress volatility, and maintain confidence in fiat-based financial systems. But here is the hook that demands attention: markets can be managed, but they cannot be controlled forever. What we are witnessing today is not a random fluctuation, but a structural shift in how power is exercised within the silver market. In recent years, major financial institutions have quietly reduced their aggressive short exposure to silver. This change is subtle, yet economically profound. Banks do not abandon profitable strategies without reason, and they certainly do not surrender control without recalculating risk. The reduction in suppression is not an act of generosity, it is a strategic retreat. The cost of maintaining artificial price pressure has increased, while the margin for error has narrowed. Regulatory scrutiny, rising delivery obligations, and growing transparency in futures markets have all raised the stakes. When the risk of physical delivery failure begins to outweigh the benefit of paper dominance, even the most powerful players reassess their position. Here is the moment that should make every serious observer pause. The institutions that once dictated the price are now adjusting to it. This signals a transition from price control to price accommodation. Banks are shifting from defending a ceiling to managing exposure, and that distinction changes everything. In economic terms, this represents a move from active intervention to passive risk management. Once intervention declines, price discovery begins to reassert itself. And price discovery, when delayed for years, does not return gently, it returns with force. Another critical factor behind this shift is the growing disconnect between financial instruments and physical reality. Paper silver markets expanded dramatically, allowing leverage to grow far beyond the available physical supply. For years, this imbalance functioned because confidence remained intact. But confidence is a fragile currency. As industrial users, sovereign buyers, and long-term investors increasingly demand physical silver rather than contracts, the pressure on institutions intensifies. Banks are not stepping back because demand is falling. They are stepping back because physical accountability is rising. And when accountability rises, manipulation becomes expensive. This evolution also reflects broader systemic changes in global finance. Rising interest rates, unstable debt structures, and persistent inflation have forced banks to prioritize balance sheet stability over aggressive market domination. Silver, once considered a manageable and relatively small market, now carries asymmetric risk. The upside exposure of being short in a tightening physical market is unlimited, while the downside protection has diminished. Rational economic actors respond to asymmetric risk by reducing exposure, not by doubling down. That is exactly what we are seeing. The most overlooked aspect of this shift is its psychological impact. Markets are driven not only by supply and demand, but by expectations and behavior. When banks stop actively fighting price increases, market participants notice. Investors interpret this as a signal, not a coincidence. Momentum builds not because of speculation alone, but because the perceived barrier has been removed. When the referee steps back, the game changes. Capital flows adjust, hedging strategies evolve, and price resistance levels lose their meaning. This is not a sudden collapse of institutional influence, it is a calculated repositioning. Banks are not exiting the silver market, they are adapting to a new phase of it. They are transitioning from controllers to participants, from suppressors to risk managers. That transition marks a critical inflection point. Because once the dominant players stop enforcing artificial constraints, the market is left to confront reality on its own terms. And reality, especially when delayed, has a way of moving faster than anyone expects. The global silver market is facing a supply reality that is far more restrictive than most headlines suggest, and this constraint is not theoretical, it is physical, measurable, and increasingly unavoidable. Silver is not produced in isolation, it is largely a byproduct of mining for other metals, such as copper, lead, and zinc. This single fact changes everything. When base metal production slows due to economic cycles, environmental regulations, or declining ore grades, silver supply contracts automatically. Here is the hook that demands attention. Silver cannot respond to higher prices with higher production in the way most commodities can. The supply side is structurally inflexible, and markets rarely price that in until it is too late. Over the past decade, global silver mine output has stagnated and, in some regions, declined outright. Aging mines are producing less each year, while new discoveries have become rarer, deeper, and more expensive to develop. The capital required to bring a new silver mine into production is enormous, and the timeline often stretches beyond 10 years. Even if prices rise sharply tomorrow, the physical response cannot arrive quickly. This creates a lag effect that tightens supply precisely when demand accelerates. In economic terms, this is a textbook setup for price repricing, yet it remains widely underestimated. Adding further pressure is the steady erosion of above-ground silver inventories. Unlike gold, which is hoarded and recycled efficiently, silver is consumed. It is embedded in electronics, solar panels, medical devices, and industrial components that are rarely recovered at scale. Once used, much of that silver is effectively gone. The market has been drawing down stockpiles to meet demand, quietly masking the true imbalance. Here is the uncomfortable truth: inventories are not abundance, they are borrowed time. And borrowed time always runs out. The industrial transformation of the global economy has intensified this supply strain. Silver is a critical input in renewable energy infrastructure, particularly photovoltaic solar cells, where efficiency gains have not eliminated the need for the metal. Electric vehicles, advanced electronics, and military technologies all rely on silver's unmatched conductivity and reliability. Unlike speculative demand, industrial demand is non-negotiable. Manufacturers cannot substitute sentiment, they need material. When supply tightens, they do not wait for better prices, they secure inventory. That behavior changes market dynamics rapidly and decisively. What makes the situation even more compelling is that recycling has failed to scale fast enough to compensate. While recycling contributes meaningfully to supply, it is constrained by collection inefficiencies, technological limitations, and economic viability. Recovering small amounts of silver from complex products is costly and energy intensive. As a result, recycling growth has lagged behind industrial consumption. The gap between what is used and what is replaced continues to widen, creating a persistent structural deficit. Deficits do not announce themselves loudly, they reveal themselves through stress. This stress is increasingly visible in delivery times, lease rates, and procurement strategies among industrial users. When buyers shift from just in-time purchasing to stockpiling, it signals concern about future availability. Markets often ignore these signals until they are reflected in price, but by then, positioning opportunities have already passed. The silver market is small relative to global capital flows, which means even modest relocations of demand can have outsized effects. Tight supply does not need massive new demand to trigger volatility, it only needs sustained pressure. Another critical dimension is geopolitical risk. Silver production is concentrated in a limited number of regions, many of which face political instability, regulatory uncertainty, or infrastructure challenges. Supply chains are no longer assumed to be seamless. Disruptions that once seemed temporary now carry long-term consequences. When supply security becomes uncertain, risk premiums rise, whether markets acknowledge them or not. Scarcity does not need to be absolute, it only needs to be feared. The tightening of physical silver supply is not a future possibility, it is an ongoing process. Each year of underinvestment, each ounce consumed and not replaced, compounds the imbalance. Markets can ignore fundamentals longer than expected, but they cannot ignore them indefinitely. When supply constraints collide with rising demand, price becomes the only mechanism left to restore balance. And when that mechanism activates after years of suppression, it tends to move faster and further than most are prepared for. Silver is no longer merely a monetary metal or a passive store of value. It has become a strategic industrial resource embedded at the core of modern economic growth. The acceleration in industrial demand is not cyclical or speculative, it is structural. Entire industries now depend on silver's unique physical properties, and there is no true substitute that matches its electrical conductivity, thermal efficiency, and reliability at scale. Here is the hook that reframes the conversation. When a metal becomes essential to progress, demand stops being optional. Silver has crossed that threshold. One of the most powerful drivers of this demand surge is the global energy transition. Solar power, particularly photovoltaic technology, requires silver for its conductive paste, which enables efficient energy transfer. As governments commit to aggressive renewable energy targets, solar installations continue to expand at record rates. Each panel may use only a small amount of silver, but when multiplied across millions of installations, the consumption becomes enormous. Efficiency improvements have slowed the growth of silver usage per panel, but total demand continues to rise because scale overwhelms optimization. Growth does not ask permission, it compounds. Electric vehicles represent another accelerating force. Compared to internal combustion vehicles, electric vehicles use significantly more silver due to their complex electrical systems. Power management units, charging infrastructure, and onboard electronics. As global automakers race to electrify their fleets, silver demand rises in lockstep. This is not a trend driven by luxury or consumer preference alone. It is driven by regulation, climate policy, and industrial competition. When policy mandates demand, price sensitivity diminishes. Manufacturers secure materials first and negotiate costs later. Beyond energy and transportation, silver plays a critical role in advanced electronics and digital infrastructure. From semiconductors and printed circuit boards to 5G networks and data centers, silver is embedded in the systems that power the digital economy. As artificial intelligence, cloud computing, and automation expand, so does the demand for high-performance, low-resistance materials. Downtime and inefficiency are far more costly than higher input prices. This reality reshapes procurement behavior, favoring reliability over cost containment. Defense and aerospace sectors add another layer of demand that is often underestimated. Military applications require materials that perform flawlessly under extreme conditions, and silver's reliability makes it indispensable in guidance systems, communications, and advanced weaponry. These sectors operate on long-term procurement cycles and strategic stockpiling rather than spot market pricing. Once demand enters this category, it becomes insulated from short-term economic slowdowns. Strategic demand does not retreat, it accumulates. Medical and healthcare technologies further intensify this trend. Silver's antimicrobial properties are used in wound care, medical devices, and hospital environments. As global healthcare systems expand and aging populations increase demand for advanced medical solutions, silver usage grows steadily and persistently. This form of demand is quiet, consistent, and largely invisible to traditional market analysis, yet it adds another non-discretionary layer to overall consumption. What makes the rise in industrial demand particularly powerful is its resistance to substitution. Engineers can redesign products to reduce silver content, but only within narrow limits before performance degrades. Substitutes often compromise efficiency, durability, or safety. In high-stakes applications, compromise is not an option. Over time, this locks in baseline demand that does not retreat even during economic contractions. Recessions slow consumption, but they do not erase necessity. The cumulative effect of these forces is a demand profile that is broader, deeper, and more resilient than at any point in modern history. Silver demand is no longer dependent on investor sentiment alone. It is anchored in infrastructure, technology, and national priorities. When multiple sectors compete for the same finite resource, pricing power shifts. Markets may debate valuation, but industry enforces reality. And when demand becomes structural rather than speculative, it does not fade, it tightens its grip year after year. The silver market operates within a dual structure that appears efficient on the surface, but hides a growing imbalance beneath it. On one side exists a vast paper market composed of futures contracts, options, and exchange-traded instruments. On the other side exists the physical market, where real silver must be mined, refined, transported, and delivered. For years, these two worlds moved in parallel, held together by confidence and settlement mechanisms. But here is the hook that exposes the tension. When promises multiply faster than metal, trust becomes the only collateral. And trust, once questioned, changes everything. Paper-silver markets expanded rapidly because they offered liquidity, leverage, and price discovery without the immediate need for physical settlement. A single ounce of physical silver came to underpin dozens, and in some cases hundreds, of paper claims. This structure functioned as long as most participants were content with cash settlement rather than delivery. But economic systems built on rollover assumptions are fragile. When a growing number of participants begin to demand physical silver instead of paper exposure, the imbalance becomes visible, and the system's tolerance is tested. This divergence between paper claims and physical availability introduces a fundamental risk delivery stress. Futures contracts are designed to be settled, but the assumption has always been that only a small fraction will result in physical delivery. As industrial users, sovereign buyers, and long-term investors increasingly seek direct ownership, the margin for error narrows. Warehousing capacity, registered inventories, and logistics infrastructure are suddenly scrutinized. The moment people ask for metal instead of money, the rules change. The economic consequences of this imbalance are profound. Paper markets can suppress volatility and smooth price signals in the short term, but they cannot manufacture supply. When physical demand tightens, paper prices lose their anchor. At that point, the market faces a choice: allow price to rise duration demand or risk a failure of confidence. Historically, markets resolve this tension through repricing, not negotiation. Price becomes the mechanism that restores equilibrium when contracts outnumber commodities. Another critical factor is transparency. As market participants gain access to inventory data, delivery reports, and leasing rates, the narrative of abundance becomes harder to sustain. Rising lease rates signal scarcity. Delays in delivery raise questions. Sudden rule changes in cash settlement incentives attract attention. These are not random events, they are stress indicators. Markets speak in signals long before they speak in prices. Those who understand the signals position early, while others wait for confirmation that arrives too late. The paper to physical imbalance also reshapes risk management behavior among financial institutions. Banks and exchanges must manage counterparty risk, reputational risk, and systemic risk. If confidence in physical backing weakens, even temporarily, the cost of maintaining leveraged paper exposure increases. Margin requirements rise, liquidity thins, and volatility returns. This feedback loop accelerates repricing rather than containing it. What was once a tool for stability becomes a catalyst for change. From a broader economic perspective, this imbalance reflects a deeper shift in how value is perceived. In periods of monetary stability, paper claims are sufficient. In periods of uncertainty, tangible assets regain prominence. Silver, sitting at the intersection of industrial necessity and monetary history, becomes a focal point. When investors and institutions move from abstract exposure to physical control, it signals a reevaluation of risk that extends beyond a single market. Physical assets do not depend on confidence, they replace it. The longer the divergence between paper obligations and physical supply persists, the more abrupt the resolution tends to be. Markets rarely unwind imbalances gradually when leverage is involved. Instead, they reset through repricing events that catch participants off guard. The silver market's unique size amplifies this effect. It does not require massive capital inflows to experience significant price movement. A relatively small shift from paper to physical demand can overwhelm available supply and force rapid adjustment. This imbalance is not a theoretical flaw. It is an active tension shaping market behavior today. Each contract written without corresponding metal increases sensitivity to disruption. Each ounce removed from inventory tightens the system further. Eventually, the question becomes unavoidable. How many promises can 1 ounce fulfill before price is forced to speak? The current macroeconomic environment has created conditions that are uniquely supportive of silver's role as a monetary hedge, and these conditions are not temporary disturbances, but structural outcomes of policy decisions made over decades. Persistent inflation, expanding sovereign debt, and ongoing currency debasement are not isolated variables, they are interconnected forces reinforcing one another. Here is the hook that reframes the discussion: inflation is not a failure of the system, it is a feature of how the system now survives. And when inflation becomes embedded, assets that cannot be printed move from the margins to the center. Inflation erodes purchasing power silently and continuously. Even when official data suggests moderation, lived experience often tells a different story. Energy, food, housing, healthcare, and education costs continue to rise faster than wages in many economies. Central banks respond by adjusting interest rates, but these tools are constrained by the sheer scale of global debt. Raising rates aggressively threatens financial stability, while lowering them fuels further inflation. This policy dilemma creates an environment of negative real interest rates where savers are penalized for holding cash. In such conditions, silver reemerges not as a speculative play, but as a rational response to monetary erosion. Global debt levels have reached historic extremes. Governments, corporations, and households are all deeply leveraged, and servicing this debt requires either sustained economic growth or accommodative monetary policy. When growth falters, monetary expansion fills the gap. Debt is not repaid in real terms, it is diluted. This is the quiet mathematics of debasement. Over time, currencies lose purchasing power, not because of mismanagement alone, but because dilution becomes the least politically disruptive option available. Silver's relevance increases precisely because it exists outside this system of dilution. It is no one's liability. It does not depend on interest rate policy, fiscal promises, or central bank credibility. While currencies compete in a race to the bottom through devaluation, silver remains finite. This contrast becomes more visible as monetary policy grows more experimental. Quantitative easing, balance, sheet expansion, and liquidity injections normalize conditions that would once have been considered extraordinary. Markets adapt, but value seekers recalibrate. Currency debasement also alters international dynamics. As reserve currencies weaken in real terms, confidence in fiat systems becomes more fragile. Trade imbalances, geopolitical tensions, and weaponization of currencies have encouraged nations to rethink exposure to purely paper-based reserves. While gold often dominates this conversation, silver benefits indirectly from the same loss of confidence. It is more accessible, more liquid for smaller actors, and deeply embedded in the real economy. When trust in money weakens, trust shifts to matter. Another important dimension is inflation's impact on behavioral economics. As consumers and investors internalize the expectation of rising prices, decision-making changes. Cash is spent faster. Long-term contracts demand higher premiums. Tangible assets are favored over promises. This shift reinforces inflation itself, creating a feedback loop that central banks struggle to break. In such an environment, silver's dual role as both an industrial input and a monetary hedge becomes particularly powerful. It benefits from economic activity, while protecting against monetary decay. What distinguishes the current macroeconomic cycle from previous ones is duration. Inflationary pressures are no longer viewed as transitory by market participants, regardless of official language. Supply chain restructuring, energy transitions, demographic shifts, and geopolitical fragmentation all add persistent cost pressures. These forces do not reverse quickly. Monetary systems adjust slowly, often reactively. When time works against policy, hard assets work in favor of patience. Silver's historical role as money gives it psychological credibility during periods of uncertainty. It does not require belief in innovation or growth narratives, it requires recognition of arithmetic. When more currency units chase the same or fewer goods, value must reprice somewhere. Silver offers a conduit for that repricing, especially when confidence in policy solutions erodes. It does not promise yield, but it preserves optionality in a world where certainty is increasingly scarce. The convergence of inflation, debt expansion, and currency debasement creates an environment where silver's function extends beyond diversification. It becomes a signal asset, reflecting stress within the monetary system itself. As macroeconomic imbalances deepen, silver's relevance is not argued, it is revealed through behavior, allocation, and necessity. Price discovery in any market is the process by which true value is revealed through the interaction of supply, demand, and risk. In the silver market, this process has been delayed, distorted, and compressed for years by structural interventions and leverage. That delay has consequences. Here is the hook that reframes expectations. When price discovery is postponed long enough, it does not resume gradually. It reappears as repricing. Repricing is not an opinion, it is a mechanical response to imbalance. The potential for silver to move toward significantly higher price levels emerges from simple economic arithmetic rather than speculative enthusiasm. When supply tightens, demand remains resilient, and intervention weakens, price becomes the only remaining variable capable of restoring equilibrium. Unlike markets with deep elasticity, silver's supply cannot expand rapidly in response to price signals. This inelasticity magnifies price movement once thresholds are crossed. A small mismatch between availability and demand can produce outsized reactions, particularly in a market of silver's size. Repricing potential is further amplified by the structure of capital flows. Silver is a relatively small market compared to global equities, bonds, or real estate. It does not require trillions of dollars to move prices meaningfully. Even modest relocations from institutional portfolios, sovereign reserves, or industrial stockpiles can overwhelm available supply. When a narrow door meets a growing crowd, movement accelerates. This is not volatility for volatility's sake, it is scale mismatch. Another catalyst for rapid price discovery lies in behavioral dynamics. Markets often remain complacent until a visible threshold is breached. Once resistance levels fail, sentiment can shift quickly from skepticism to urgency. Participants who previously ignored the asset move to gain exposure, not because fundamentals suddenly changed, but because price validated them. This reflexivity compounds movement. In silver, where years of suppression have compressed valuation, this effect is magnified. Price does not climb, it resets. The plausibility of higher price levels, including figures once dismissed as unrealistic, becomes clearer when measured against historical and monetary benchmarks. Silver has previously traded at much higher real values when adjusted for inflation, currency expansion, and gold ratios. Meanwhile, the monetary base has expanded dramatically while silver supply has not. Valuation is not about nostalgia, it is about proportionality. When currencies multiply and metal does not, price must reconcile the difference. Repricing is also influenced by institutional behavior under stress. As prices rise, short positions become liabilities rather than tools. Margin requirements increase, liquidity thins, and risk managers intervene. This creates forced buying, which accelerates upward movement. What began as organic demand becomes systemic adjustment. Markets often underestimate this phase, assuming rational pacing where none exists. Risk, once ignored, demands immediate resolution. Industrial users contribute another layer to price discovery dynamics. When prices rise, manufacturers do not necessarily reduce consumption. Instead, they secure supply. This front-loading of demand tightens the market further, reinforcing price momentum. Unlike speculative buyers, industrial participants cannot exit the market entirely. They absorb higher prices because operational continuity depends on access. Necessity removes the luxury of waiting. The psychological dimension of price discovery cannot be ignored. Long periods of suppressed prices create disbelief. Early price increases are dismissed as temporary or manipulated. But as movement persists, disbelief turns into acceptance, and acceptance turns into fear of missing access. At that point, price becomes a message rather than a number. Silver's revaluation, once underway, feeds on recognition rather than persuasion. Repricing events rarely provide comfort or clarity in real time. They are characterized by volatility, narrative shifts, and rapid reassessment of assumptions. For silver, the path to higher price levels is not linear and does not require universal agreement. It requires only that physical reality assert itself through price. When that happens, markets do not ask whether a number is reasonable, they ask whether supply is available. And when availability becomes uncertain, price stops being debated and starts being discovered. So as I close, remember this: silver doesn't need permission to rise, it only needs truth to surface. And truth is surfacing right now. Whether silver reaches 50, 100, or beyond is not just a price discussion, it's a confidence discussion. Confidence in currencies, confidence in systems, confidence in the future. The question is not whether silver will move. The question is whether you will move before it does. Because when the banks stop fighting the price, they're not surrendering, they're repositioning. And in every financial revolution, those who reposition early don't just survive, they lead.